In 2007, Lehman Brothers stood as the pinnacle of success, with shares valued at $86 each and a market capitalization nearing $60 billion. Yet this towering financial giant was destined for a cataclysmic downfall. Just a year later, Lehman Brothers found itself in a dire predicament, burdened by an astonishing $619 billion debt. It ultimately succumbed to its financial woes, filing for bankruptcy and etching its name in history as the largest ever corporate bankruptcy in the United States. Discover the gripping tale of Lehman Brothers' meteoric rise, its risky investments in the housing market, and the catastrophic events that led to its ultimate downfall. The beginnings of Lehman Brothers. Lehman Brothers was established in 1844 in Montgomery, Alabama by Henry Lehman, a German immigrant. Initially, it operated as a dry goods and general store, but soon Henry's brothers, Meyer and Emmanuel, joined him, leading to the formation of Lehman Brothers in 1850. During the 1850s, the company gained prominence as a commodities trading firm, specializing in the lucrative cotton market. The transformation of Lehman Brothers from a commodities trader to an investment bank commenced in 1906 when it collaborated with Goldman Sachs on an initial public offering (IPO). Over the next 2 decades, Lehman actively engaged in underwriting nearly 100 new equity offerings, including those from renowned companies like F.W. Woolworth, Studebaker, and Macy's department stores. The history of Lehman Brothers reflects the evolution of investment banking in the United States economy. Despite experiencing significant national challenges such as the Civil War, both world wars, the stock market crash of 1929, and the subsequent Great Depression, the company managed to adapt and even thrive. Throughout its existence, Lehman Brothers underwent numerous transformations, spin-offs, and mergers, ultimately emerging as one of the world's largest investment banks. Success in the 1990s. Shearson/American Express acquired Lehman Brothers in 1984 for a reported sum of $360 million. American Express retained ownership of Lehman Brothers until 1994, when it decided to separate the company through an initial public offering (IPO). The IPO attracted over $3 billion in new capital for Lehman Brothers. This separation became possible due to the repeal of the Glass-Steagall Act, which had previously prohibited banks from engaging in both investment and commercial banking activities. With the removal of this restriction, Lehman Brothers expanded significantly by offering a combination of these services. Despite the challenges faced after the tragic events of 9/11, Lehman Brothers managed to maintain its prominent position in the investment banking industry. By 2007, it had risen to become the 4th largest investment banking firm in the United States. A significant portion of Lehman Brothers' growth and profitability came from sustainable investments in mortgage-backed securities, MBS. Ironically, these very investments ultimately led to the downfall of the company. The housing market and subprime loans. By the mid-2000s, Lehman Brothers had heavily invested in mortgage-backed securities, MBSs. The housing market experienced a boom during this time, resulting in an excessive creation of MBSs and collateralized debt obligations, CDOs. Lehman Brothers emerged as the largest holder of MBSs by 2007. Furthermore, in 2003, Lehman Brothers made a significant move by venturing into loan origination. The company acquired several lenders, some of which specialized in offering subprime loans, a type of loan that the US government had been promoting since the early 2000s. Lehman Brothers' substantial investments in MBSs, many of which contained subprime mortgage loans, proved to be the catalyst for its downfall. These investments, which seemed promising at the time, ultimately played a major role in the demise of Lehman Brothers. The housing market crash. The subprime loan bundles, which were highly risky and poorly structured, posed a significant threat to the market throughout 2007 and into 2008. However, the initial signs of the crisis were evident as early as 2006. As the housing market started to slow down, the number of mortgage loan defaults began to rise rapidly. The sheer volume of subprime mortgages became unsustainable. Despite the mounting risks, Lehman Brothers stubbornly increased their investment in the housing market and mortgages. They acquired a substantial portion of the real estate market, spending over $100 billion on mortgage-backed securities and assets in 2007. Competition and failure. In the midst of the financial crisis in 2008, Lehman Brothers, a prominent investment bank, faced a challenging and uncertain future. Its main rival, Bear Stearns, had already succumbed to the flames of the crisis, ultimately leading to a buyout by J.P. Morgan Chase with the support of the Federal Reserve. This deal, while stabilizing for Bear Stearns, created an air of uncertainty surrounding Lehman Brothers. Lehman was already in a weakened state due to its heavy reliance on repurchase agreements, repos, for daily funding. To restore market confidence, the company embarked on an equity fundraising initiative in the early summer of 2008. Unfortunately, this attempt fell short when in September, Lehman announced an anticipated third-quarter loss of nearly $4 billion. Adding to its woes, the company also reported a staggering $5.6 billion loss from toxic asset write-downs. These dire financial indicators further eroded Lehman Brothers' position in the markets and intensified concerns about its long-term viability. The stage was set for a tumultuous and fateful period in the coming days, as Lehman Brothers would soon face a fate similar to that of its fallen competitor, Bear Stearns. The end of Lehman Brothers. Lehman's stock plummeted some 77% in the first 7 days of September 2008. Richard Fuld, the CEO at the time, attempted to save face in front of investors and keep the doors open by using multiple tactics, including a spin-off of the company's commercial real estate assets. Investors saw Lehman for what it was, a sinking ship. The clear signal that investors were running came with the swelling of credit default swaps on Lehman's debt, as well as the backtracking of major hedge fund investments. The final straw dropped by September 15, when, after attempted buyout rescue deals by both Bank of America and Barclays fell through, Lehman Brothers was forced to file for bankruptcy, an act that sent the company's stock plummeting a final 93%. When it was all over, Lehman Brothers, with its $619 billion in debts, was the largest corporate bankruptcy filing in U.S. history. Following the bankruptcy filing, Barclays and Nomura Holdings eventually acquired the bulk of Lehman's investment banking and trading operations. Barclays additionally picked up Lehman's New York headquarters building. Lehman's collapse was a major contributor to the domino effect of multiple financial disasters that eventually became the global financial crisis of 2008. Many in the industry still wondered why Lehman was allowed to fail, rather than being rescued by the US federal government like so many other banks were. One reason often put forward is simply the massive size of Lehman's debt and the woeful inability of its assets to begin to cover it. Impact of Lehman's bankruptcy. Lehman Brothers' bankruptcy had a devastating effect on financial markets, leading to the worst decline in the Dow Jones Industrial Average in 7 years. The Dow dropped by 504.48 points, reaching a 53% decrease from its peak. Investors sought safety in U.S. Treasury bonds, causing prices to rise. The collapse of Lehman also affected the Reserve Primary Money Market Fund, which broke the buck with shares devalued at $0.97 due to losses from Lehman's commercial paper. This triggered a record-breaking withdrawal of $196 billion from money market accounts, posing a threat to businesses' daily operations. To address the impending credit card meltdown, Treasury Secretary Paulson and Federal Reserve Chairman Bernanke sought a $700 billion bailout from Congress. This would involve purchasing troubled bank shares to inject capital into the financial system swiftly. However, Congress rejected the proposal, resulting in a historic drop of 777.68 points in the Dow, the largest single-day decline until 2018. In summary, Lehman's bankruptcy caused a ripple effect. With significant losses in the stock market, increased bond investments, the devaluation of money market funds, and a rejection of the bailout plan by Congress, leading to further market turmoil. And that wraps up today's video. Thank you so much for watching. If you have any video topic suggestions, let me know in the comment section down below. And yes, make sure to subscribe to our channel for more inspiring content.